Can everyone hear me, hopefully? Cool. All right. Wanted to thank everyone for coming today. I'm super excited to share with you just a little bit of information about how I built my property portfolio. I know I've spoke to probably a lot of people in the room already, and I'm very excited to share with you exactly how I did it, share with you tips, tricks and strategies on basically how I went from basically living in housing commission. I grew up in, for those of you who don't know, I grew up in Western Sydney in housing commission from Mount Druitt. It started with a massive drive that I wanted to be the first one to buy property, and I wanted to get ahead financially in life. So I realized from a young age that people that get ahead, they usually own property. And that's where I got very passionate, and I wanted to buy property as soon as I could. So I've got a few slides here that we'll go through today. And before we get started, as per usual, is this working? Sorry. Before we get started and jump into things, general disclaimer, as everyone probably knows, I'm not a financial advisor. I'm a very passionate property investor. I'm not an accountant. When you are looking to invest in property, go see an accountant, financial advisor if you wish. I didn't myself when I started off, but that's a bit about that. So today I want to share basically, the 3 keys to success, the things that we're going to be going through today, 3 keys to success. Also sharing with you properties that I've been recently buying, which property market that we're focusing on right now in 2024, and how we can help you along the way, and also my free gift to you today, which a lot of people hopefully have already got today, which is the book. Sorry, we're moving too quickly. All right. So again, I grew up in Western Sydney, started from nothing. I've got over 85 investment properties, 86 investment properties in my portfolio. Today, they're probably worth about 60 million at least. And today, I'm just very passionate about sharing thoughts, opinions, so we might do a questions and answers after this as well. Hopefully, a lot of people have heard of the book, 30 Properties Before 30. There's a new one coming out as well. Oh, I'm just skipping to the good bit, sorry. I've been in the media, for those of you who haven't seen me before, I've been in the media probably since 2015, at least, when I had about 4 or 5 properties. I'm in the media, on TV and all that kind of stuff every 6 months. The main 3 things, so let's just jump into it. The main 3 things is, the first thing I want to talk about is buying a property that is essentially what some people will refer to as under market value. Now, many people have a different idea about what under market value is. And because to me personally, a property in itself has a range of value. It doesn't have one value, there's always a range. And I was speaking to a few people earlier in the other room about this, but if anyone in this room has ever sold a property, if they get the property appraised, it's going to have a range of value. A real estate agent will say, well, we can sell your property probably for $550,000 to $600,000. And then if you ask another real estate agent, they might say you $570,000 to $600,000, and so on and so forth. And the same thing when you get a property valued by the bank, you can take one property to 4 different banks and they can each give you 4 different valuations. So under market value to me is basically buying a property where other ones are selling for more, and mixing that with buying it in a very, very hot market where hypothetically we're buying a property for, let's say, $400,000, when you can see there's a lot of other properties on the market for $450,000, offers over $449,000, and so on and so forth. And then you can see other sales. You can see sales and the trajectory of which the market is growing, so you're actually getting equity on the way in. And that's one of the 3 things that every property must have, regardless of whatever property type it is. I've found from my experience that a lot of people, when they see the word property, they think of a house. And to me, a property is a property. It could be a house, could be a townhouse, could be a unit, could be a villa. Out of the 85, 86 properties I own, some are houses, some are townhouses, some are units, some are villas. But the main 3 keys of how I bought them have always remained the same. Below market value, really high yield, and a property that's actually going to grow in value. So, second thing is yield. What is a yield? Yield's obviously, hopefully everyone in this room knows what a yield is. Could maybe everyone raise your hand if you know what a yield is? You know what a yield is? Yep, all right, cool. So a good yield to me would be, in excess of 6%. Now, I bought properties that have lower yields, of course, but majority of the properties in my portfolio and the ones that I recommend to buy in the current market would, especially with high interest rates right now, would be 7 or 8% yields. And if you're going to build a portfolio of, let's say, 6 or 10 properties, you might have some low yields in there for like 5 or 6%, and you might have some very high yields in there for like 8, 9, 10%. And I've found everyone, especially people that live in Sydney, they throw the yields out the window because they just think that Sydney grows the most, which Sydney doesn't grow the most. It is the most expensive state, yes, but it does not grow the most. And I could show you stats and statistics that back that up over the last 30 years. It does not actually grow the most. Now, jumping into growth regions be the third thing. And I'll try to go as quick as possible because I know we're limited time here today. But high growth locations, to me, I always try to focus on a property in a location that would be a relatively metro location. So to me, metro would be, let's say, 30 to 40 minutes from a capital city-ish, maybe an hour. So when I was buying back in Queensland, as an example, in 2020, like between 2015 to the last few years, does anyone own here properties in Queensland here? Anyone? Raise your hand. Yep. All right. So Queensland, as an example, has gone through a massive, once in a lifetime, or once every 15 years at least, big growth cycle. Properties that we bought in 2018, 2019, 2020, everything's doubled now in Queensland. If you bought an existing property then it would have doubled over the last 3 years. So growth, to me, is a combination of trying to time the property market for a state that's going to have the biggest amount of growth in the shortest amount of time. And that's where we'll go on to cycles in a minute. But the three things to summarize: buying under market value, high yield, and high growth. There's lots more into it, and I can only go through so much today, but I've got hundreds of free videos. It's all free. You can get the books for free as well, which it shares more information about that. We'll jump into some properties. These are examples. Some people might laugh because they might, some might look really nice, some might look a bit ugly, but these are properties that we've been buying recently in Perth, as an example. This property here, to start off with, is a unit/villa. Now, this property, 18 kilometres from the city. 18 kilometres from the city. If you think about and compare Perth as an example, 18 kilometres to Perth, you can get there in like 20 minutes, right, on the freeway. 18 kilometres from Sydney, you would not be able to find a property for 285K. Pretty sure there's 285K. It's 2-bedroom, it's modern, it's clean, it's tidy. It has low strata. Strata's only like $500 a week. Not $500 a week, $500 a quarter. But the main important thing is this property, it actually rented for more than 500. It rented for 520. So the yield return on that, even at 500, was 9.1%. We bought it for 285. You can barely even buy these for like 380 at the moment now. But 285 was a prime example. You couldn't even build the property for 285. And it's not a house, no, but it's fundamental. And anyone, I believe, can get started with a property like this. That's exactly what I did. For those of you who haven't read the book, I got started with a 2-bedroom unit in the Central Coast, and I used it as a stepping stone. So I believe in taking the stepping stone approach, and the rest is history. For everyone that loves houses here, this is a house that we picked up, 430K roughly. 4-bed, 2-bath, double car lock garage, 40K under market at least. Houses are very hard. This was probably about 8 months ago, and to get it cheap now would probably be 520. But that's still cheap. To me, these are going to go up even more. They'll probably hit 750, 800K. Because when you look at this house as an example, how much does it cost to build a house in today's dollars? It probably cost as much as we paid to buy the house and the land. And that land itself, I'm pretty sure, was 500 to 600 square meters. It was a corner block, been renovated inside, kitchen's been renovated, updated. Like, that to me has all the capability, and it to me is just logic that it's going to double. So again, does it tick the main 3 boxes? And to me, it does. We bought it for 430. To me, it was worth 480. Client bought it. Rented out for I think it was rented at the time. They got like $600 a week for it. So the yield is about 7%, and massive growth potential. This is not out in the middle of nowhere. This is pretty sure doesn't even say how far it was away. Pretty sure where this was at was like 20 kilometers from Perth CBD. 20K's out. Pretty sure, I'll give you the suburb. Pretty sure it was in Stratton. But it's not about the suburb for everyone that thinks it's about suburbs. This is another example. This is what they call in Perth is a villa. Villas are very similar to houses. This technically had no strata fees. A villa is basically, let's say we've got a 1,000 square metre block. Someone 5, 6, 7, 10 years ago has chopped up the block and put 4 houses on a 1,000 square metre block. And it's like, it's on 250 square metres of land as an example. Again, a lot of people just focus on land. I do own properties with land out of the 85, but I don't discriminate. Any property is a good property. Any property that will make money is a good property. I do not discriminate. So this one here as an example, 3 bed, 2 bath, 1 car. And it says 500, but I know for a fact this property, it ran out for like 600 a week. So the yield was through the roof. It was like 9%. A client bought this, they bought like 3 other properties, then they bought a house, then they bought a unit, then they bought a townhouse. They bought like 5 in like a very short period of time. One of the last ones, this one's a bit of an ugly duckling, as most people would probably agree. It's a 2-bedroom unit. We picked this up for $243. This was 4 kilometres from Perth CBD. Now, to me, when I see a 2-bedroom unit, yes, it has strata, but it was probably only, I think it was like $600 a quarter. And for those of you in the room that don't understand that strata, because it has a taboo, and I get it, that strata's, eat into your profits and all that kind of stuff. But strata, in a whole, it includes the building insurance. For those of you who don't know that, I've found, you don't teach that stuff in school, unfortunately. But if the strata was, let's say, $2,300 a year. If you were to buy a house, then you're going to pay $1,400, $1,500 a year in building insurance anyway. This one was in a small block, relatively small. I bought in smaller blocks as well, but there was no elevator, there's no pool, there's no gym, so the holding costs are really low. So we rented it out for $420, and these slides were honestly made probably about 3 months ago. You probably get $450, $480 for that now. But again, a 9% rental return, 4 kilometres from the city. So like, jump on Google Maps, jump on realestate.com, look at 4 kilometre radius. It's not about the suburb. That's one thing I want to stress. It's about trying to buy a property in any suburb that's in a good that's in a metro area, that's actually under what it's worth, with growth and with yield. But that's 4 kilometres. So jump on there, figure out what's 4 kilometres. You'll see affordable stuff. Whether you come through us and I help you out and buy property, or you buy a property on your own, you're going to hopefully learn something. You've already learnt. You can get really good value 4 kilometres from Perth, sorry. So the main 3 things, again, to me, it's $243. We bought it under market value. Even now, we're picking up 2-bedders like that for like $300. And $300 is still cheap, or $280. But you can't even get them for $243 anymore. This is from like 6 months ago. But $280, $300 is still cheap. When you classify 4 kilometres from Perth, capital city, how far away do you have to go to get a property for $243, which has 2 bedrooms? You couldn't even go to Bathurst and get a 2-bedroom property for $243. You can't even build a granny flat for barely $243. Land doesn't cost that much. So to me, it's logic to me, but it's because I'm obsessed with doing this. And a lot of people might say it looks ugly, but it's fundamental, right? It's 2 bedrooms, it's brick, like $420. The thing's going to keep going up in value, and over time, like you couldn't even rebuild it for that price. So probably a no-brainer, focusing on Perth. I'm buying a lot in Perth at the moment. I've bought, hundreds and hundreds of properties for clients in Perth. I own 15, 18 at least. I wish I could buy more. I'm trying to buy more, but I'm kind of stuck at the moment with finance, so that's a constant issue. But Perth to me has all the capability of doubling in value, just like Queensland did. If you go on YouTube videos, like 3-4 years ago, I was talking about Queensland. And everyone's like, Queensland, like, Eddie, you're buying in Queensland, you're buying in, Brisbane and Ipswich and Moreton Bay and Logan and Gold Coast, and like, why are you buying all these properties here? Because I believe that they were undervalued as a whole general place, and they were undervalued. And then they all doubled over 3 or 4 years. To me, Perth is undervalued. Going back to the other slide, how is Perth, if that's 4 kilometres from the city, then like, how is it not undervalued? It's got, like, to me, the last boom in Perth, I'll explain a little bit about the Perth market right now. And these states, they go in growth cycles. And Perth, as an example, has been relative. Perth's had a bad reputation for the past 10 years. Everyone will probably agree with that here. But many people forget that Queensland had a bad reputation for growth as well. Queensland, between like 2009 to 2020, Queensland barely moved. And when I was showing people properties in Queensland in like 2018, 2019, they're like, why are you showing me this property? Because it hasn't grown in 10 years. And I'm like, there's data, there's a method behind the madness. And what I've found from looking back 20, 30, 40, 50 years, 60 years ago, is that markets will go through cycles. So this is somewhat an example of a cycle. So it's probably not as much of a cycle that I would agree with, but you know, it obviously goes through a trough, it goes through a peak, there's a rough area, and it kind of tapers off, and then it goes through another peak. So between, if you bought here, and then you bought there, that period could be literally like 7 to 10 years. So if you buy at the wrong time of the cycle, it doesn't matter how fancy the suburb you buy in, doesn't matter if it's Bondi, doesn't matter if it's wherever, like, it's not going to have the big amount of growth. I'm looking for the biggest amount of growth, and I'm trying to buy like right here as it's going through the cycle. The sad thing about this formula is that when I'm saying I'm going to buy right here, this period has not been too good. So people are like, why are you buying there? You must be crazy. Why are you buying there? But it's happened again and again. And Adelaide's doubled, did the same thing in Adelaide. It's just, these go through cycles. And Perth, as an example, the last cycle that it's been in, people probably remember it, people called it the mining boom. Back in 2013, 2014, they called it the mining boom. And now Perth isn't reliant on mining. I'm saying this because I can imagine people thinking this question in their head. Perth's top two things that's, job sectors and things like that, it's actually healthcare and tech at the moment. Like, yes, there's regional towns and mining booms and all that kind of like mining towns, but I'm not talking about mining towns. I'm talking about 30, 40 kilometres from, Perth CBD, or 4 kilometres, like that little unit that I showed. So yes, Perth has not had much growth in the last 10 years, but to me, that's one of the reasons of why it will double the next 3 or 4 years. And if you look at the stats, it's already jumped up 20 to 25%. I probably don't have the stats on this. Maybe you do have stats on here. But Perth's actually gone up even more than that. While Sydney hasn't had much growth, Melbourne hasn't had that much growth, Queensland's starting to taper off. It still has growth there. Adelaide's exploded, but Perth is still the one that's been, even with interest rates, it's still going up. And if interest rates drop at the end of the year, then it's going to be the biggest explosion that Perth's ever seen in the next few years. So a couple things that I've seen, it's like how you can retire early. To me, I believe in you do something that you love and you just keep doing it, and you climb one mountain and there's always another mountain. So it's like, I always thought that I'd have 10, 15 properties, and then I just go on the beach and relax and chill and all that kind of stuff. And while I've done lots of holidays and trips overseas, you need something to focus on next. So to me, property is one of those things that you can do in your spare time, side business, side hustle. But property is an awesome thing. Even if you get started, whether you're 20, 30, 40, 50 or 60, you can still buy affordable properties and have that on the side. Prime example, even if you got started with a property for 350K, right? I've showed you properties there for 240, 300, 400. If you hold it for the long term, the average percentage value of growth per year in Australia is actually 6.5%, even go 5%. Be more conservative. Realistically, it's going to double in 7 to 10 years, or even sooner than that if you buy in the right market. So it's just, to me, it's a no-brainer that property is the best thing to have. And not just one, but where the power actually comes in is if you have a portfolio. So anyone can have 1, 2 or 3 or 4 properties, but there's a statistic which a lot of people hopefully have seen. 90% of investors only have 1 or 2 properties. If you have over 1 property in this room, can you put your hand up? 1 property? 1 property? What about 2? You leave your hand up if you've got 2. I'll keep going until the hands come down. All right, 3 properties, 4 properties, 5 properties, 6 properties, 7, 8. All right, all good. We've got a few people. That's great. So the thing is, if I'm going to invest in property, I would always want to be the 1%, you know, like that's me. I've always been competitive, whether it's playing basketball or whatever it is, like you want to be the 1%. So the power of investing in property is having multiple. The more multiple properties that a person has, to me, the less risky it is because it might seem very counterintuitive, but like the more you have, and if they're affordable properties, let's say one's 400K, one's 350, one's 500, one's $1 million, but you've got different, if you have one property and it's rented out for, let's say you buy a commercial property for $5 million and the tenant leaves, you just got one property. Where if you split it up and you diversify different states, different markets, you get the gist. So if you have a property portfolio of 3 million as an example, even in 30 years, if you just sit there and do nothing, tenant's going to pay it off, property's going to be worth, their portfolio is going to be worth probably 12, 13 mil, even if it just sits there. So even if you go to by year 17, you put by then, if you do interest only for the first 3 or 5 years, by year 15 as an example, the loans will be half paid off, or like year 17 or 18, whatever it is. So it's just a winning formula. To me, the property is the best asset to invest in to me. So real quickly, I won't spend too much time on this, but how do I get a lot of properties that I get, I'd say 80 to 90% that I usually get, I'm usually not on real estate or domain. People talk about distressed sales all the time. Yes, there's some of them are distressed sales, but I've found the number one fact, or one of the factors that why you can get a property that's not on real estate or domain and you can get it under what it's worth is if there's an existing tenancy in place. So if there's an existing tenancy in place, like hypothetically, someone needs to sell their property in the next 2-3 months. Could be a good reason, bad reason, whatever it is. If they need to sell the property next 2 or 3 months, but they've got a tenant on a fixed lease until December. This prime example, I've seen it happen thousands of times. They've got a tenant in there till December. The real estate agent they're trying to sell with, they've signed up with LJ Hooker, Ray White, whatever. They're about to put on the market, but they haven't put on the market yet. If they've got a tenant in there, it makes it harder to sell. Why is that? Because it's harder to sell it to an owner-occupier. It's harder to take people through the property and do open for inspections. When a tenant's in place, you can't just say, open the door and say, everyone in this room, let's go check out the property, right? Because there's legalities that you can't just go into the place. So you've got to schedule open homes, you've got to put the sign out the front, the tenant might be a bit messy, they might have their kids running around, they might have stuff on the floor. So, you can't do the fancy furniture marketing, make it look really fancy and jazz it up. So that's one of the big things. If a property's tenanted, there's opportunity there. And there are a lot of ones that I buy, 90% are usually tenanted, they usually have a lease in place, and the seller might have needed to sell because of a situation, financially, a good reason, a bad reason, whatever. They're trying to buy another property. But they need to sell, the tenant refuses to move out because they know that it's probably under rented because the rents have gone up so much the last 12, 18 months. And then who's got to buy it? You've either got the selling agents basically either got to find a buyer that's willing to wait till December or January to move into it next year. So they've got to buy a property they can't move their family in, so that buyer's gone. And really only an investor can buy it. So that's where, to me, the opportunity lies. If a property would normally sell for, let's say, $550, you can pick it up maybe for $485 or $500 as an example. So tenanted properties, to me, if it's properties tenanted, I know there's generally an opportunity there. The other thing, as an example, people probably heard of the 4 Ds, debt, divorce, disaster, death, whatever it is. That's another thing as well, altogether. But there's always properties that sell for more. If anyone in this room knows real estate agents, and if the real estate agent has a lot of experience, if they've sold hundreds and hundreds and hundreds of properties, then they would be able to tell you, oh, that property went for cheap, So there's always, you can get properties that are below market value. But the question is, does the average person have enough time to do that? So how did I go about buying a lot of these properties that are not on real estate or domain? It's from being very passionate and somewhat crazy about real estate, and first obviously buying all the properties I have, and then as I've built my portfolio, I bought a real estate agent off Michael, I bought it off Nick, I bought it off Jack, and all these real estate agents, They continue to list new properties every single day. If you know a real estate agent, they're on the phone, they're trying to get listings. They're trying to hunt and find out who's going to sell. So I'm on the phone with agents like this, and because I bought properties off them before, for myself, for clients, whatever it is, I got another one coming up, and to them, if it's tenanted, then it's an easy deal. They don't have to go out there, they don't have to run back and forth and get in contact with the tenant, they don't have to put a sign out there, they don't have to do all that kind of stuff. So yes, I'm not here to say that, basically that's how I get a lot of access. So building up relationships with real estate agents mainly. There's other ones there, sellers directly. I bought directly from sellers. Sellers have seen my head on television and been like, hey, I got a property, I don't want to pay 20 grand to sell my property. Will you just find a buyer for it? And I'm like, sure, for the right price. So they saved 20 grand in selling fees, and the client bought it at a good price, and so on and so forth. So I will give you a key thing here is people can build up these connections. Like each and every one of you can do this. If I can do it, then all of you guys can as well. It just takes a lot of time, takes a lot of energy, takes a lot of effort, and not everyone has that. If you're young and you've got no kids, I've got 2 kids now, so if I start again right now, it'll be a lot harder. But it is possible to do this. So you can find, but it just takes, you got to call thousands of people, thousands of agents, and you might call up an agent, and then you always ask them, do you have other ones coming up? They've always got other ones coming up. So that's how you start to get access to off-market deals. But you've got to obviously have the knowledge and education behind it before you do that, and before you really hit the ground running. So for people that are too busy, as an example, we can help you along the way. Again, I always encourage everyone, it's really up to them. I don't push. This is the first time I've ever done a speaking event. So I don't push to get more clients and all that kind of stuff, where we've actually got an issue with, a lot of people want to deal with me, and that's a good thing. But for those of you who might want help, as an example, obviously this is where a property buyer's agent comes in. Clients will work directly with myself. I'll be able to do the work. If a person's busy, they've got kids, they've got family, they're working 60 hours a week, this is where we can help. We buy properties. I'm talking to the client as an example, presenting them properties and really explaining, why I would buy the property, the facts, the figures, the data, the statistics, everything like that. They're showing, so all that kind of stuff. So that's how we can help. If you're interested, literally, not today, but if you're interested, just jump on the website, have a bit of a look. No matter what, there's so many different videos out there, the book, all that kind of stuff's for free. So hopefully you'll learn something no matter what happens. We've got courses as an example. We've got courses where I've literally everything I'm saying today, but 10 times fold more. That's on the website. You can check out. And today, to finalise, basically, hopefully most everyone, if you haven't got the book, there's copies. Hopefully we've got some left, but everyone in the room, I don't know why that's doing that. Free copy of the book. This is in the bookstores for usually 30, 40 bucks. I've got a few hundred copies here today, so run and get the book. You have to see my team. They'll chat to you. If you have any questions, I'd love to chat to every single one of you here, but of course it probably won't have enough time. But chat to them. Teams at the back, raise your hand, team. Woo! For mortgage broking questions as well, like Justin, wherever he's at, I'm not sure where he is, but he's at the back. He's a mortgage broker himself. He's got 19 properties. So no matter what you do, if you're going to get advice from people or help from someone that's buying property, make sure they own property as well. Because there's a lot of property spookers out there. They sell brand. I don't sell brand new, by the way. This is all existing stuff. I only show people what I would buy myself. So there's a lot of people that sell brand new properties, and a lot of you just don't know how many they actually own. I've been on TV for 7 or 10 years. Started in Mount Druitt, I grew up very poor, etc. I've done it, so that I believe personally that gives me the right to be able to share with you today my opinions and thoughts and philosophies. You might not agree with them. Hopefully will agree with them, but no matter what you do, if you use a company, make sure they actually have properties themselves. To me, it's so simple, but you will be surprised every single day. People forget about it. So if you're chatting to your accountant, if you're chatting to your mortgage broker, your financial advisor is another story, go on all day. But a lot of them don't have property. I spoke to financial advisors before, and there's a friend of a friend basically, but he was giving people advice that have $3 million, they have a business, they've got lots of property, and the guy literally has he's got no property, he's 25 years old. I'm like, why would that guy go get advice from this kid, as an example, that has no property. So like, anyway, you know what I mean. The frustrations of this industry. So anyway, be careful as an example, no matter what you do. If you're chatting to a broker, if you're chatting to an accountant, then you're like, all right, you give me this, if you give me this advice, your accountant, they might not have properties, they might have 3. And if you want 10, then they're probably not the right accountant to show you how to get there because they've only got 3 and they don't have 10 or whatever it is. You know, so mortgage brokers, financial advisors, accountants, I would always, when I was at 7 or 3 properties as an example, I would only read books as an example of people that had 50 or 100. And there's not many books out like that, but there was one that I read, and then I watched, you know, as many YouTube videos and talked to people. Even if they had 7, I would listen to them when I had 2. I'm like, they have the right to tell me what to do because they have more experience than I do. But with that, we might do a quick, like 10 questions. So, not sure if we're meant to do questions, but anyone have a question? Awesome.
What is the rate you can choose from the property value?
The rate that we can usually get properties from the property value. Advertised, yeah. So, well, 80–90% are not advertised. So that's like to me, the average price point would be between at least 10%. It can range from 10% to 30%. Yeah. Thank you. Yeah.
Besides Perth, what's another market or capital city that you could see grow sort of after Perth, or is there another market?
Another market besides Perth, I would say, look, to me, Perth will be the #1 place that I'll be investing in for the next 3 or 4 years, and I'll be buying as many as I can there before I go anywhere else because it's in line with the cycle. But other affordable capital cities, like it would probably loop back around to Brisbane or it would hit like far western Sydney. Western suburbs, like they haven't moved that much surprisingly in quite a long time. So I'd say Brisbane, parts of Brisbane. I always try to go metro. Adelaide, but Adelaide's doubled, so I wouldn't really go. If I had to pick anywhere else other than Perth, I'd probably say Brisbane. You've got the Olympic Games in another 8 years or whatever it is. And it doesn't mean necessarily it's going to go up, but it's somewhat affordable, even though it's doubled still. It's still cheaper than Sydney, Melbourne. Any other questions, boys? Any questions? Nope. Yep.
So everything looks pretty rosy right now, and I mean interest rates are high, but they should come down in a couple of years, right?
Yeah.
Are there any macroeconomic events that can shake elsewhere in the world, like the US and the issues in the Middle East, blah blah blah, and that could have an impact on the local property market?
Macro big, or look, that to me is a very big question. Like, look, could there another war happen? Could another war break out? Absolutely. I'm not predicting one, fingers crossed, but like, there's always things like that can go wrong. But let's say interest rates didn't go, like they're predicting now, if you read the news, they're predicting rate cuts in this year and rate cuts next year, so fingers crossed. But let's say it didn't happen. Let's say rates continue to go up. Where it comes back to the formula of how the 3 things that I always invest in, which is under market value, growth, and yield. If I'm buying, like, let's say one of the properties there that I bought for $285. If that was worth, let's say, at least $50,000 when I bought it, right? It was bought at under market value by $50K. If, let's say, something catastrophic happened. Now, let's say when the GFC happened around 2008, the Australian property market, if you look at stats and statistics, I wish they were here. Brooks got them, so she can send them to you. The Australian market only dropped by like 10%. So during the GFC, the Australian market went down by like 10 to 12%. So again, if you buy something that's under market value by 10 to 15%, and even if it did come back, you still just goes back to what the price you paid for it anyway. So that's why the 3 key strategies is not about just making the most money, but it's about mitigating the most risk as well. Because if you buy something that's, let's say, 10% under what it should be, what it's worth, as an example, and the market collapse, which a collapse in Australia is the only collapse, wasn't even a collapse, it went back 10%. So if it came back 10%, it would still be worth what it is today. If the interest rates went up, that property for $285, I wish I could find it, it was rented at like $500, $520. So the yield was like 9.5%. So interest rates are 7% at the moment-ish, 9%. The yield's higher than the interest rate. So you've still got a bit of buffer there. You're not going to go bankrupt from that. So, and then of course you're buying in a growth market, so it's good. So long answer to that question. Apologies, but that's my answer. Yeah.
Do you you own any regional properties?
Regional. I used to own one in Cairns. I sold it, but I only sold it to, I was stuck buying properties and to buy another one. I don't have any regional that I own at the moment. I'm not totally against it. I am in a little bit, but I would, if someone has a budget, let's say of like 450, and if you're in Sydney, people are saying regional because Sydney's really expensive. We're in Sydney right now, so like I only got budget of 400K hypothetically. So they're like, oh, I'll go regional. I can drive to Orange or Wagga Wagga or Tamworth or whatever it is. I can drive 3 or 4 hours away to Bathurst. That's the only reason why I generally think most people are talking about regional, because they want to see it, they want to touch it, they want to feel it. But one of the things is you've got to take the emotion out of it. So if you had a budget of, let's say, 300,000, you could buy a 1-bedroom or 2-bedroom unit. You could buy a 1-bedder in regional town, or 2-bedroom, or a very, very cheap house in a regional town. But a regional town, let's say, hypothetically, it's a regional town in New South Wales, 8 hours away. The regional town might only have 50,000, 100,000 people in it. So to me, the amount of, like, if you've got 400K, regional town might have 100,000 people, but Perth's got 2 million, and it's the same price. So infrastructure, tenants living there, population growth, I'd pick for the same price. That's the way I kind of think. For the same price, I'd go to the bigger capital city. That for this, and the yields are even the same. So yeah. Sorry, long question again. Long answer again. All right. Yep.
Having never used the buyer's agent before, what would the fees usually be like? Is it based on the percentage of the property?
Yep. Yeah, so using a buyer's agent, my team can help you out with this, but very quick spill of this, and there's more information on the website. But some buyer's agents do a percentage, some do a fixed fee, we just do a fixed fee. Basically, the idea is if someone doesn't have the time, the research, the thing to do it themselves, if we get a property, let's say it's below market value by like 50 grand, and if someone's going to pay, whether it's 16K, 18K, whatever. There's buyers agents out there, not us, that charge like double what we charge, believe it or not. But if someone pays that fee, let's say hypothetically of 18,000, 16,000, whatever, hypotheticals, that's just the rough probably industry standard. 16 to 18K is the industry midpoint. If someone's going to pay that kind of amount, but they're getting something that's, let's say, 50K under what it's worth, then that is the return on investment. And obviously they get to speak to, they get guidance from someone who's actually done it before. There's a lot of buyer's agents out there, we've been around since, 2017, 2016. They're everywhere. Everyone's becoming a buyer's agent now. But again, going back to what I mentioned before, just make sure if you do use someone else, totally fine, absolutely, but make sure you question how many properties do you actually own, because there's a bunch of them right now, and I would love to mention their names. They've got like one property and they've got the, say they're the best buyer's agent, etc., and they'll say they'll be able to get you to 10 or 20 properties. I'm like, but you don't even have, you've got one property yourself. So anyway, yeah.
Do you prefer to pay your mortgage down personally, or just sit on interest-only loans?
Good question. So the question, I'll just repeat it. So do I prefer to pay the mortgages down or just sit on interest only? Depending on the situation. Look, me personally, I'm 33-ish now. I believe hopefully that I'll live for more time. So if I'm buying a property right this second, I will probably whack it on interest only for 5 years-ish, if it's an investment property. And the reason I do that is because interest rates are high as hell right now. If you do it on principal and interest, it's definitely not going to cash flow itself. But during that 5 years, I believe if your goal is, it depends on what your goal is, of course, but if your goal is to buy 6, 10, 15 properties and go as hard as you can, then to me, you should really be focusing on either growing or minimizing, growing or paying the mortgages off. It's either one or the other. Because if you're going on principal and interest, even if you have say 6 properties on principal and interest, and let's say if you whacked them over to interest only, you might save $500 a month times 6, which is X amount. So at the end of the year, you might have 40 grand left, 40 grand extra in your pocket. The 40 grand, buy one of these little things. So you can buy more properties in a shorter succession, usually if you go on interest only. So it's in saying that now, the ones that I bought when I was 18 years old, they're on principal and interest. So I do it for 5 years and then I just let them roll over to principal and interest. And then they start paying themselves off. So no matter what, they're going to be paid off in 30 years. That's the worst case scenario. But if I was young like you, I'd just go interest only, buy as many as you can. if you want the stats that I'm about to mention, FY, like I can, if you Google the team admin at it's there, admin@dilleenpg.com, there's a PDF that we've actually put together, and it has Australian Bureau of Statistics data from like Australian Bureau of Statistics and CoreLogic and all that kind of stuff. It takes the prices over the last, so long-term hold, what you were mentioning, let's say long-term 20, 25, 30 years, right? Believe it or not, in 1990, I wish I could show you this, but the prices of each state were put down, had the average price, the average home price of each particular state. And then you've got the average home price in 2023. The percentage of growth over a 30-year term is shockingly similar over 30 years. Sydney, even Tasmania technically grew more than Sydney over 30 years in percentage value when you break down the percentage value year on year on year. The average across all the states in Australia worked out to be around, it ranged between 5.9% to like 6.3%. So long term, I have a very overall holistic kind of overview general approach to it. So I definitely believe it is. I wouldn't go and sell and then buy other ones to try to keep doing that and switching states, but that the stats and statistics, like it blows the average person's mind, and many people don't even believe it. But like Sydney 30 years ago was always more expensive than Perth, you know? It is now. And it's probably, let's say it's the average median price in Sydney, off the top of my head now, it depends on units and houses, but the median price in Sydney, as an example, might be 1.2. Perth, hypothetically, is like 500,000 as an example, or 400,000. The average is very cheap, the median price. So it's like, it's over double. 30 years ago, the price range was double and double. Like it was the same kind of ratio 20, 30 years ago. And then they go through these cycles where they, long answer to a short question. Hopefully that helps.
When you're buying in Perth, do you physically fly out there first and sort of suss out the property first, or do you just have faith in someone that's there?
Good question. When I first started buying in Perth, I had property managers go physically inspect it. Like we have an office in Perth that does property management. So basically, I don't physically go fly out there to see them individually myself, but we have property managers that go through the properties, and there's different things. And so yes, a property manager will go out there prior. If you're buying in Perth, you're buying existing, you've always got a 21-day finance pest and building clause. So let's say I'm buying a property today in Perth, I call up, even if you find one, it's like 400K, I put in an offer, it's accepted, I've got 21 days, then you can fly there. I don't personally fly there to go see it myself, and a lot of the properties I bought for myself, I didn't physically go there, but I had, the real estate agent FaceTime me, I had a video walkthrough. Most importantly though, during the 21-day period, I had a pest and a building inspection. So pest and building inspection costs like $500, and if anything's wrong within 21 days, you just pull out and get your money back anyway. You don't get the $500 for the pest and building back, but if you put a deposit down for $5,000, then you do get that back in Perth, whereas Sydney you don't. Because the legalities from different states are different from state to state. So the few things that you can do is, get a pest and building, get someone to take a video walkthrough, so it's like you're there anyway. Jump on Google Maps, if it's tenanted, which the good properties are usually tenanted, get a routine inspection report. So you can basically just get the current property manager who's managing it to send you through a routine inspection report that would have been sent to the seller, and that's basically where a property manager's gone through and take photos and the tap's leaking as an example. So you get a list of those maintenance items even before and usually they're done in different states every 3 to 4 months. So you kind of know what you're going into regardless. So yeah. We'll do 2 more questions. Yeah, 2 more. Yeah.
When will interest rates go down?
When will interest rates go down? No financial advice. Look, to me, I believe, and again, no financial advice, but I believe what the banks have predicted recently, and there's been all throughout the media articles, that they should come down towards the end of this year. They should start cutting them. There's videos that I've done like a year and a half ago, whenever they started raising rents or raising interest rates. There's videos on YouTube. I wish I could play it because it says what I'm about to say. Usually when rates go up, rents go up, rents went up. And usually you've got 1.5 to 2 years of pain, which we're going through. Everyone's been through pain. It sucks because interest rates are up. People renting properties, the rent's gone up, people own property. So, but usually 1 or 2 years they come to stabilise a bit. I don't think they're going to go back down to 1 or 2%, but I believe, let's say mid next year, if the average rate's 7%, then I believe mid next year-ish, then they should hopefully be in something with a 5 in front of it, rather than a 7, fingers crossed. Or, yeah. Last question and then we'll wrap up.
What LVR are you sort of personally trying to make when you had 70 properties, you said you're maintaining about 50% LVR. Just curious why 50%, obviously is a bit way more leverage at the start, especially if you're taking interest only. Why, like, just curious about that. Is it true?
What is it now, or what do I recommend, or what, or both?
I guess what is it now? And
Yeah.
why did you write 50%?
Yeah, for sure. So at the moment now, there's probably in total assets, this is property and assets and different kind of assets as well, there's 60-ish kind of million. I'd probably say loans on that are around 22, 23 million as an example. So I haven't worked out the percentage of that, but it's probably like 40% or something like that. I don't like that, actually. I would prefer to buy more properties. I'm just stuck with finance at the moment. So, yeah, sorry? Same, yeah. So I do have a healthy LVR based off the amount, and the cash flow is about the cash flow as well. The cash flow, the rents have gone up, and the rents have exploded. Properties that I was buying, if they were renting for 200, they're renting for like 600 now, and so on and so forth. So it's a compound effect when you buy small properties. It makes it safer as well. But if someone's young, like if I was starting again, I was talking to these guys over here, like you can get in with a 5% deposit, 10% deposit, if you really wanted to. Use the LMI and get in sooner, especially if you're young, or depend how aggressive you want to be, you can get in with that. And then your LVR is technically 90%, but if you buy something 10% under market value, technically, then you're buying really at 80% anyway. So, yeah. Cool. Awesome. Thank you all. Oh, Laura, last question.
Sorry. What are the opportunities, let's say, for illegal land in other states like Perth or Queensland?
Yeah.
And what are the options available that use as is, but after down the line, after 1 or 2 years, you build something over there, subdivide or make it as a dwelling and sell it off that portion?
Yeah. Look, yeah, so the question was basically, buying a property, subdividing, having multiple things, and then subdividing for a profit. Yes, that is, like, people can make money from that, for sure. That is a good thing to do if that requires obviously a lot of it's like you're looking at the exact figures to make, if you make a profit, then if you sell it, what are the fees, what are you paying, what are the accounts, what are, the capital gains and everything like that. So, yeah.
You can use it to buy another one.
Yes. So there'll be more of like a building kind of thing. Like, yes, it's good to do. Have I subdivided personally? No. Out of the 85, 86 properties-ish, I haven't subdivided. I've got properties that I might do it in the future, but if you're stuck with servicing what you said, then yes. Whatever you can do to get to the next level, whether it's making equity or cash flow, then it is to be done. Like a lot of people, no financial advice again, a lot of people when they get stuck with serviceability in their individual name, they think they're tapped out. I was tapped out multiple times, and then I used my super, I rolled my super into a self-managed super fund and used the super as a deposit, because that is a different borrowing capacity than what your individual name. So if someone's tapped out and they've got 3 or 4 properties and they're tapped out because of finance, they can't get finance because their wage hasn't grown or the property's rents haven't gone up or whatever reasons, that is it may be an option to explore. So, but I've done videos on YouTube like that, yeah.
Except that super, what are options available?
What are options available? What do you...
For serviceability, for finance?
So, again, not a financial advisor, not a broker, but basically a lot of people overlook it. It's a different borrowing capacity. So like from my personal experience only, I've got about 7 or 8 properties in super. When I've been tapped out in my individual name for certain periods of time before I could get my tax return done or whatever it may be, like I've then used super because you can be tapped out individually and then you can buy through super. It goes off basis. Justin's a broker. He can explain this a little bit more easily, but it goes off your super contributions. So if someone's making hypothetically 100,000 per year, they get 9.5%. It goes off the super contributions plus the actual rental income that property's going to get. So it could get another, and 20% deposit. Usually the super, the minimum deposit's 20%. So with people, if someone has 80 grand in super, that's 20% on an affordable property. So yeah, you can get in with as little as like 75K. Like I've done it, I've had hundreds of clients do it. So yeah, cool. Yeah, wanted to wrap up. Thank you all so much for coming.
If you haven't, thank you so much for the wonderful presentation. There were so many very useful insights in that presentation. I'm sure everyone agrees, right? Wonderful. So yeah, once again, thank you, Eddie.